All right, I'm going to talk about dollar cost averaging in my 401k or my retirement plan. So I get money every paycheck that I put into uh, my retirement plan. Most brokers will tell you just pick these five funds and invest this percentage and then don't look at it. But I think in the old days that might have worked well. The market is so volatile now that I think you have to accumulate money and then buy when the markets are down, as they are now. So I'm just going to go over one of my investments I have with TIAA. They have American Funds Perspective. Um, I wouldn't buy five different funds if I didn't have any money. I'd try and load up at least one fund you believe in and get some decent funds in there. I built this up to 100,000 before I started buying something else. You're already diversified because when you select holdings here, you see how many different companies you are actually investing in. So you are diversified with one mutual fund in several companies. This fund happens to be heavily diversified in the tech fund. So you might find something that you think is appropriate for you, but for me, the tech fund is the most appropriate investments for the last 20 years. So I'm still writing that out as of now. But anyways, I thought I'd just show you guys what I've done for the last year. So again, I don't invest in anything on my paychecks. All my money goes to a cash fund, and when I see buying opportunities, I dollar cost average in at that time. So I'll show you what I mean here. This is that fund, RNPGX is the American Funds New Perspective. Okay, so it's in my eyes the most aggressive tech fund I could have with the TIA, so that's where I got to put it. So, anyways, I was investing in 2019 when the market tanked on the COVID news. I was buying, and what you see here in green is just before the end of the year, I took profits out. So I took some money off the table, and red would be anything I'm buying. So I really felt like the market was high, and I wasn't buying anything from these times up here, December 1st, 2020, July 31st to 2021. I went all 6 months without buying anything. So I was just riding the market out. And in fact, in late July, I took profits out a couple times. Um, Normally, I would not do a trade for 1 month after one trade. So this is a little uncharacteristic, but I felt it was high, so I decided to take some of my profits out and buy back if the market were to go down. So after that, July 31st, so this is July 1st to December 31st. So I'm showing the last two sells I had. And then the market did go up some more. In hindsight, it would have been nice if I knew that and I would have sold right here. I didn't sell at this time, but it just percentage wise wasn't up very much for me to take profit. So I was just riding out to see what happened, and the market dipped. I tend to take all that money I've been saving and buy in October. I'm just a believer in buying in October. October is known as the bear killer. For some reason, all the bad news comes through September, and then October is all this great news in anticipation of what's going to go on in December. So I bought, and typically I'll hold through December, but at that time I just felt like, hey, you've gone from 60 some to 72 some. The percentage of games was pretty high, so I took profits back off the table, and it went down, and I decided to buy more at this at something under 72. So I just reinvested it, hoping for a better year for next year. A lot of you know that 2022 that didn't really happen. So what you see is a D here, and that means that there was a dividend payout. So it may look like it took a big tank, but what happened was I got $7,400 of money given to me as dividends for long-term hold, and 715 for the short-term hold. So that was something purchased under 12 months or something like that. So I got about 8,000 some bucks added to my funds. So really, this becomes the new point right here. So when you see this point, if you were to drag all this from this point up to here, you can see that we are actually up. And maybe I should have sold, but I didn't. What happened in January 1st to July 30th is usually I see some of a bump up into March and then sell off in March, but it was down. It's down here. You can see it's down to 60, where I'm selling here over 70, over 67 and that. So I'm selling at 67. I never know when the market's going to come back. I'm just buying because it's lower. And if I buy, I typically won't buy for a month. This is my rule. Wait a month. Let the market do whatever it's going to do. Because if it's going to tank, it tanks for another month, then you can buy more at a lower opportunity, a better price. You have so I didn't buy, or I didn't sell. What I did was this money that I've been selling, I just put it back in at a lower price, hoping it would go up. It didn't, so it went down. But all that money I've been saving and not buying here at prices of 60 to 67, I'm now buying in at prices under 55. So typically, I would sell around here in May and take profits. I was hoping that this would continue up around here, but it didn't. There's a saying in the market, go away in May. Market tends to have low volumes then, tends to maybe dip or go flat. And at that time, you'll see a lot of investing in like utilities, defensive plays, maybe gold. It just kind of depends, but less aggressive type of growth funds, and more of your blue chip funds in May. So anyways, I look for opportunities to buy in again and then hope it goes back up in September, and then sell in September and buy back in October. However, this year, you see that I should have sold here, didn't. So I bought more here. And now I'm starting to get into all that money that I was saving during the this whole month when I didn't buy, or this whole quarter or half a year, December to July, where I didn't buy. I had money to buy it at a lower price. Now here's a mistake. I still make the same dumb mistakes. I don't follow my own rule where I say wait a month. So really, after this buy here, I'm okay with this buy, even though it went down. It would have been nice to know it was going to go down. But even with this buy here, once I made that buy, I should have waited until here to be buying again. These two buys I should have never did. I don't know why I don't follow my own rule, but wait a month and then make your buy. You see, if I would have followed my own rule, I would have been better off buying a little more here at this level. Really thought this might be a low level, but the whole recession and inflation has really turned things down. I've still got money that I've been saving. So these are monies. This is what I call dollar cost averaging. I'm buying when I decide the market's down. I will buy on the dips, and that works until a recession hits. If we never come out of the recession, then all these buys are going to be bad news. If in 4 or 5 years we come out of the recession, anybody buying on these recession prices, you're going to be rewarded for doing that. So there's no guarantee that that's going to happen, but that's what happened over the last 100 years. So just based on past performance, it gives us our best opportunity to maximize the types of profits you can make. So a lot of people ask me, when do you buy? What do you know? How do you know to buy when you buy? I generally look for a 10% drop in the market, and then to me that's an attractive buy. 15 to 20% drops in the market, that to me says, hey, that's a strong buy. Typically speaking, have a 20% drop, the next year or two, we've had strong gains. So, uh, again, my rules: wait 30 days before you buy or sell again. Um, 3-day weekends tend to be a good buy on a Friday because people don't want to go long on the weekend. So, a lot of times you'll see markets drop. Um, August, September, October, somewhere in there, there could be a big dip. If you get a big dip, that's your opportunity to buy. It's the scariest opportunity because everything's down, and always, every time this happens, it's like the end of the world, and you shouldn't have bought. But then 6 months, 1 year, 2 years later, like everybody talks about, oh, if you were smart enough to invest when it was down, you would have made such and such profit. So our only chance really to make money, if you don't have your own business making a ton of money, um, is to find investments in businesses that make money and ride their tails to help you get your portfolio up to something valuable so you can retire. Okay, so look at your last highs and lows. Look at your 52-week highs and lows, all-time highs and lows. These are indicators of buying and selling for me. And I don't sell all and I don't buy all. I accumulate and I save. So, like, let's say I saved up $10,000. If I have $10,000 October 1st, I might put 5,000 to work. Just if you have 5,000 and then put 2,500, what do you got to lose? Put some money in there. See if you can't buy. It makes more sense to buy now at these prices than it did a year ago when it was up over $70 $70 a share. So, all right. So I'm sharing my information with some of the people that have asked, how do I invest? What do I mean when I dollar cost average? So that's what I do. Good luck to you.